If banks lived by the same advice that they gave, they would be bankrupt. Let me show you. What do banks want you to do? They want you to save your money in the bank. Now, when you give your money in the bank, your bank has this cash, but your bank doesn't want to save money. Because if your bank was saving this money, they would be bankrupt. Instead, what they do is they tell you to save your money in the bank. That way your bank can then invest this money. How does your bank invest this money? They give you a mortgage, they give you a credit card, they give you a line of credit, they give you debt, and in exchange, you pay the bank interest and you make the bank richer. Which is why what I want to do in this video is I want to go over 7 secrets that your bank does not want you to know. That way you can understand how to use the banking system to your advantage, because unfortunately, the majority of Americans don't know how. Secret number 1 is that your savings are an asset for the bank, but a liability for you, and maybe not in the way that you think. When you go and save this $100 that you work to earn in the bank, you think that this is an asset for you because now you have this money and you have it accessible in the bank. But your bank looks at this money very differently than you. See, what happens is when you take that $100 in the bank, you get a receipt from the bank saying that you have this $100, which is why you think it's an asset. But here's what the bank does. On the bank's books, not yours, on the bank's books, they have this liability, which says that they owe you this $100. That receipt says the bank owes you $100, which is why the $100 is a liability to the bank, which makes sense. But then what the bank does is they follow something called a fractional reserve lending system, which means that they take this $100 that you deposited and they don't keep it saved in a vault. Instead, they want to invest this money. So what do they do with this $100? Well, they're going to take most of it, let's call it $90, and they're going to invest it. So they're going to take 90 of this dollars and they're going to give it to this person right here. Now, when the bank lends out your money, remember, this was a liability for the bank. They lent out your money. Now it has become an asset for the bank. How did it become an asset for the bank? An asset meaning investment. Because now the bank takes your money and they turn it around and give it to somebody else. That way this person has to pay the bank back this money plus interest. But remember, they're using your money. So now this asset that you gave to the bank, well, now it's given to somebody else. That's how fractional reserve lending works. The bank takes your money, they give it to somebody else, and then guess what? This person takes this money and they're going to deposit it in a different bank. Now, your money is in bank 2, and then this process happens again. This person gives their money to bank 2, and bank 2 is going to lend this money to somebody else. And it goes on and on and on. And that's why you have to understand that the money you give to the bank, you think is an asset for you, but it's really an asset for the bank. Now, I'm not saying this so you don't save any money in the bank. I'm saying this so you understand how the banking system works, and I'm going to show you how you use the bank to your advantage. So stick with me, which brings me to number 2, which is that your bank is not your financial advisor. Let me paint this picture for you, because the average American has 0 financial education. They went to school, got a good job, and have very little idea of what to do with their money and what they can afford. And the people that they trust with their money is their bank, because when you get paid, the money gets deposited in your bank. When you spend money, the money comes out of your bank. So now when you go out and you want to buy something nice, like say a house or a car, who do you go to ask to see what you can afford? Most people don't have a financial advisor, so what do? They go to their bank. And then they ask their bank, well, how big of a home can I afford? How nice of a car can I afford? But I'm going to let you in on a little secret. Your bank doesn't really care if you can afford to make the loan payments or not. They make money when you sign the papers. As soon as you sign the paper for a loan, the bank takes this loan and they're going to sell it off to somebody else. They make money when you close a deal. And after that, it's your issue. It's not the bank's. They are not a good judge of how big of a home you can afford or how nice of a car you can afford, which is why you need to have your own financial education instead of asking your banker how much money you should borrow. The third secret, which really shouldn't be a secret, is that banks love it when you spend money you don't have. Now you're going to hear that and you're going to say, Jaspreet, obviously, banks love it when we borrow money. But that's not what I'm talking about. One of the biggest revenue generators for banks is when you spend money you don't have, not through debt, but through your bank account. Banks are making billions and billions of dollars a year on overdraft fees, which means every time you spend $1 that you don't have in your checkings account, the bank is going to charge you $35. Now, we did a whole deep dive of this in Market Briefs because there are some new regulations being put into place which are trying to limit how much overdraft fees the banks can charge you, but that doesn't mean the banks are going to stop charging you overdraft fees, which means you have the ability before you go out and spend money, to open up your web banking and see how much cash you have in your bank account. And if you don't have $100 in your bank account, you shouldn't go out and spend $100 or $110. And if you can do that little change, this could save you hundreds of dollars a year, because people that are overdrafting aren't doing it once. They're doing it month after month after month after month. And this is where, if you can control the spending outflow, you can keep more of the money for yourself. And there's a little tip, because I think everybody has overdrafted at some point. I have too. If that happens one time, you can tell your banker, hey, I don't know how that happened. I'm sorry that this has happened. Can you please waive my overdraft fee? And then they should be able to do that the first couple of times for you at no cost. But you can't let that be a reoccurring thing. By the way, my last overdraft happened when I was dealing with my nightmare property about a decade ago. I made a video of it on YouTube. You can check that out. And for those of you that want to stay up to date on what's happening, when it's happening with things like this, you can check out Market Briefs, my free financial newsletter, where my team is working to keep you up to date on the economy, the housing market, stocks, crypto, and the global economy into a fun, witty, and easy to read newsletter. It's completely free, and I got the link for you down in the description below. Secret number 4 is that you can own your bank. And you don't need a lot of money to do this. Many of the big banks like JP Morgan Chase Bank and Bank of America and Wells Fargo and Morgan Stanley are publicly traded companies, meaning these are companies that trade on the stock market. And anybody with a stock brokerage account can go out and invest in these companies and own a piece of these banks. Now, when you own a piece of these banks, you become one of the owners of the banks and you get to share in the bank's profits. Now, as a little bit of stock market 101, some companies on the stock market pay out a dividend. That means it's the cash payment that you get without having to sell your stock for doing nothing except owning a company that's making big profits. Because when a company has a lot of profits, they can do 3 things with those profits. They can save this money, they can take that money, reinvest it back into the business by opening new stores, hiring more people, or they can take that money and just give it away to the shareholders. One of the ways that they can do that is in the form of a cash payment called a dividend. So I'm going to go through a couple examples, and of course, as a disclaimer, investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything I'm going over is just examples. I'm not telling you what to do, okay? So, example number 1. JP Morgan Chase Bank is currently paying around a 2.3% dividend yield. The Bank of America stock is currently paying around a 2.4% dividend yield. And then there's also an ETF. There's multiple ETFs, but just as an example, called KBWB. This is an ETF by Invesco, which is an institution that creates these types of funds. And this fund invests in many different types of banks. You can take a look at the holdings here. They invest in banks like Goldman Sachs, Bank of America, Morgan Stanley, JP Morgan. And at the time of me recording this video, this fund is currently paying out a 3% yield. Now, let me just go over a little bit of basics when it comes to investing. The advantage of you investing in an individual company is you can see a lot of upside. The advantage of you investing in a fund is you don't have to put in as much work and research, because if you put all of your money into JP Morgan Chase Bank, you might feel great because you're getting some dividends. But if they start doing bad things and they go out of business, all your money is gone. Versus if you invest in a fund like this and then JP Morgan goes bankrupt, well, this fund still owns shares of other companies like Bank of America and on and on and on. That way now, yes, you have some winners, but you'll also have some losers. So your risk is a little bit less when it comes to funds, and this is where you have to know your strategy when it comes to investing. If you're not willing to put in the work to analyze and keep up with companies and understand the financials of companies, don't go out and invest in individual companies, because that can really amplify your risk, or at least I want you to understand the risks. Now you might say, well, Jaspreet, okay, if I'm just investing for cash flow, well, why don't I just keep my money in a high interest savings account where I can get 4 or 5% a year versus these are paying 2 to 3% a year? What's the advantage? Well, you got to understand the difference between saving your money and investing your money. I'm going to talk about that a little bit later. But the second thing I also want you to understand is that when you invest your money, your goal is to grow the value of your portfolio, not just see this cash flow. And when you make your investment decision, you might say, if I was comparing these 3, this one seems like the clear option. This one's paying the highest cash on cash return, the highest dividend. right? Well, let's dig a little bit deeper. If we take a look at the JP Morgan stock over the last 5 years, we'll see that JP Morgan is up around 75% over the last 5 years. Bank of America is up around 41% over the last 5 years. And then this KBWB is up around 5.5% over the last 5 years. So as a foreshadow, you can see the importance of investing your money because you can see a lot of growth of your principal in addition to getting cash flow. But secondly, where it comes to deciding where you invest your money, the financial education of how you invest is so important because that can drastically change what type of returns you're going to get. Of course, you can't predict what's going to happen next year, the year after that, or the year after that. But your financial education can help lower your risk and increase your returns. The fifth secret, which is really not a bank secret, it's something I want you to understand, is you have to have a savings goal. I kind of hinted at this in the last point, which is you have to know why you save your money. And the reason why I talk about this so much is because I grew up in a traditional Indian house where in traditional Indian culture, the thing that you do is you go out and make a lot of money. You become a doctor, you become an attorney, you become an engineer, you become an accountant, you get a good salary, and then you spend no money. You live in a very small house, you drive a Toyota Camry, and you save all this money. You make 150 grand a year and you save $100,000 a year. Now the question is, why? Well, if you ask most traditional Indian households, they'll tell you, it's so you have a big bank account, because that's what provided a lot of financial stability, a lot of financial cushion, and just a lot of stress-free living because you had this big bank account. But if you really want to build wealth, you have to think a little bit bigger. Saving money is great. It's better to save your money than blow it at Gucci or Sweetgreen. No more Chipotle because we know what's going on with the Chipotle portions. But what I want you to understand now is what is your goal when it comes to saving your money? So I'm going to go over the 3 different goals that you can have when it comes to saving your money. Number 1 is you got to save money for an emergency. Number 2 is you want to save money for a purchase. And number 3 is you want to save money for your investments. When it comes to your emergency savings, this is cash you have to have. Every single person has to have cash put aside to protect you against an emergency. Some people call this an emergency fund. Some people call this a rainy day fund. I don't care what you call it. This is money you put aside and you don't touch unless you have an emergency. And no, Amazon having a Cyber Monday deal is not an emergency. This is money that you don't touch unless something really goes wrong. You lose your job, something breaks, something really bad happens. That's when you tap into this money. How much money do you want to have here? I would say somewhere between 3 months to a year's worth of expenses, depending on where you are in your life. And I know that's a huge range. But it also depends on who you are and where you are. If you're 25 years old, you're not married, you have no kids, you have very little financial responsibilities, you don't need 6 months or a year's worth of savings at this point. Maybe it's only a few months. But if you're 45, you got kids, you got financial responsibilities, you got a wife, you got a husband, you got things that you got to take care of, well, maybe you don't want to have just 3 months. Maybe it's 6 months, 9 months, 12 months, depending on your risk tolerance to make you feel more comfortable to have cash put aside. And also, if you have a business, you also want to have a separate emergency fund for your business as well, because if things go wrong, you want to make sure you can keep making payroll for a little while. So understand that this emergency fund is important for you, and if you have a business, that as well. Second, if you want to make a big purchase, you want to buy a home, you want to buy a car, you want to buy a nice watch, you want to buy a nice vacation, you can save money for these things as well. And this money can go into a separate bank account. For those of you that are financially organized, I highly recommend that. This way, you don't have to rely on debt to buy these things. And thirdly, save money for an investment. And this is also going to depend on what your investing strategy is. And what I mean by that is some of you are going to have an investing strategy where every time you get paid, part of your paycheck is automatically invested, which is great. Some of you are going to have an investing strategy where you're going to get paid and you're not going to automatically invest your money because you're looking for a good investment opportunity. You're looking for a rental property to purchase. You're looking for a good stock at a good price. You're waiting for a good opportunity to go out and invest. Because you want to invest your money, you're just looking for the right opportunity. That's fine. But you want to make sure you have a separate bank account to do that. And you don't have to pick one or the other. You can do a hybrid as well. I have a hybrid investing approach, and I can't tell you what to do. This is just what I do. For me, I have a system where every week money is pulled out of my bank account and is automatically invested. This happens whether the market's up or down. It does not matter. This happens every single week. Then I also have a system where I'm putting money aside into a different bank account. I actually have multiple bank accounts. I have one bank account to put money that I'm going to use to go out and buy real estate. And then I have another bank account where I put money to go out and buy stocks. For these accounts, I'm looking for an opportunity that I believe is a good undervalued price. Something that fits within my criteria, something that fits within my risk tolerance. But I'm not automatically just throwing my money into my investments. This money is sitting into a high interest account right now, just waiting to be invested. But the goal with this money is to be invested. It's not just sitting there to sit there. I have a bank account for my emergency money. I have a bank account for my spending money, and I have different bank accounts for my money that's going to be invested. This way, I have a goal for why I'm saving my money. Secret number 6 is you can use the banks to make money. Now, there's a couple of different ways that you can go about doing this. Number one is obviously getting a high interest savings account. That way you can earn some money. But the more sophisticated way that I'm not a huge advocate of, because I think a lot of people do this completely wrong, which is why I don't like to talk about it a lot, is using the bank's money to buy something that's going to make you money. Again, I say this just to say this so you understand the opportunities, but this takes a lot more risk, a lot more work, and you have to be a lot more cautious and smart to do this the right way. So what this means now is you go to the bank, and what most people do is when they go to the bank is they're going to borrow money to buy cars, to buy clothes, to buy vacations, to buy things on their credit card, to buy things that are liabilities. So what you're doing is you're taking next year's income to spend it today on something that's losing you money. When you buy that BMW with your bank's money, that BMW is dropping in value while you continue paying interest to the bank. That is a lose-lose for you because now you're losing value in the car and paying interest to the bank. But what some people do is they're going to borrow money from the bank. Instead of buying a car, instead of going out and financing these liabilities which are losing the money, they're going to borrow money from the bank to go out and buy a cash flow producing asset. What is a cash flow producing asset? This could be real estate. This could be a business. Now, again, I'm going to caution you here because I have seen so many horror stories that you don't want to just jump into this because you get excited about this idea of borrowing a whole bunch of money from the bank and buying an asset. I have seen stories from my own bank manager of people going into my bank to borrow $65,000 so they can buy this business that's losing money every single month that has no debt on it. And then they want to buy this business with the $65,000 on this business that's already losing money. And then they have to pay debt on top of that. And then they find out that there's no intellectual property. They have no protection. And now they have a business that's losing money. They have to figure out how to pay this interest. And they don't really have a business to begin with in the first place. So take this with caution. But what this means now is you're going to borrow money from the bank to buy something that's making money. And if you do this correctly, if you can go out and find a good property, if you can go out and find a good business that's profitable, and that this business, this real estate would also be able to pay off the mortgage and put some money in your pocket every single month, this can create an opportunity for you to use the bank's money to make more money and get some tax breaks, but this is the most risky way to go. And of course, secret number 7 is that banks love it when you're financially stupid. You might have heard me talk about this before, but the reality is banks profit when you're in debt. And most people, the vast majority of people are not going to the bank to borrow money to make money. The vast majority of people are going to the bank to borrow money to finance dumb things that don't make them any money. Now you might say, well, Jaspreet, my car is not a dumb thing. My Gucci is not a dumb thing. My extra guac is not a dumb thing. Well, let's call dumb things things that lose value. Okay? Nothing wrong with having dumb things. You want to have a dumb car? Cool. You want to have a dumb vacation? Cool. Nothing wrong with that. I want you to have a whole bunch of dumb things. But I want you to be able to afford them first. The problem is we live in a society where banks love it when you want dumb things. Not just that, they love it when you want dumb things that you can't afford. Because when you want that dumb thing and you can't afford it, the bank comes in as the middleman and they say, oh, you can't afford that? Let me help you out with that transaction with a nice credit card, a nice line of credit, a nice loan. That way you have the ability to live the American dream and have the nice things, and you just pay us back with interest. Now, I mentioned this a couple minutes ago, but what is debt from a theoretical level? Debt is a way for you to spend your future income today. When you go out and swipe your credit card and spend money you don't have on your credit card, what you're doing is you're taking next year's income and you're spending it today. And the cost of you spending your future income is interest. And so now what you're doing is you're spending next year's income, the year after that's income, the year after that's income today, and then you spend the next few years working to pay off the dumb things that you bought 3 years ago. And this is where you got to understand the game. Banks are not stupid. They spend billions of dollars every single year hiring the best and smartest MBAs and marketers to get people excited to borrow money. Right? That's their business. Banks make money when you're in debt. The more money you borrow, the more money the bank makes. The longer you're in debt, the longer the bank makes profit. They don't want you to pay off your debts. They want to keep you in debt forever. Now I get it. Some people on the internet talk about how stay in debt, that way you can get rich. But you got to remember, very few people actually are using the bank to make them money. Everybody else is losing money to the bank. And if you really want to build wealth, well then, if you stop paying money to the bank, you can keep more money for yourself. And when you keep more money for yourself, you have more money to invest in yourself. You have more money to buy stocks. You have more money to start businesses. You have more money to buy businesses. You have more money to invest in real estate. You have more money to travel and do other nice things because you're not giving all of your money to the bank. And the real unfortunate part is that being financially stupid is extremely profitable for the bank, which is why banks have been trying to target low-income, financially uneducated people many times, and they sometimes get in trouble for this with lawsuits. But that's not even the worst part. Like, we know that if you're bad with money, that you're gonna go out and borrow money from the bank. But it doesn't end there. Because when the banks know that you're bad with money, you're probably not gonna have a good credit score. And then what happens when you don't have a good credit score is you're also gonna be paying higher interest to the bank because you're a more risky investment. Like, think of it this way. If I had to go out and lend money to either Jeff Bezos, who I think is pretty good with his money and has the ability to pay me back, or my bro cousin Bunty, who isn't, who do you think I'm gonna need a higher return from to justify my investment? Probably not Jeff Bezos, right? Well, anyways, whoever you think is a more risky investment is gonna have to give you a higher rate of return, a higher interest rate to justify for the higher risk. And if you come into the bank showing that you're not good with money because you keep financing things and you can't pay them off because that's what the majority of people do is they spend money they don't have, the next thing that happens is the bank is then gonna have to compensate for the higher risk that you're bringing to the bank, and the way that they do that is with a higher interest rate. So now you walk into the bank and they see that you are a subprime borrower. This is more of a banking term which essentially says you suck with money. You have a bad credit score. Now I get it, your credit score isn't exactly your money 101, but let's just ignore that topic for now and understand what the bank says when they see the bad credit score. They say, you're bad with money. We're gonna have to compensate ourselves for the additional risk we have with you. So instead of giving you a 6% mortgage, we're gonna charge you 11%. Instead of us charging you 7% on this auto loan, we're gonna have to charge you 12%. And instead of you spending the money that you get from your paycheck, we're gonna charge you 25 or 45% in our payday loans because you can't wait until your next paycheck to start spending money. This is a huge way for the banks to make a lot of money, is because they charge you insane interest rates because you are not good with money in the bank's eyes. And if you don't believe me, let me give you an example. The average household in America has $6,500 in credit card debt today. And if you're like most people and you say, who cares about credit card debt? Everybody has a little credit card debt. And now you only make the minimum monthly payments of $150 a month. Do you know how much this credit card debt is gonna cost you? Because most people don't. You're gonna end up paying $18,000, not to pay off your credit card, but just in interest on your credit card. Which means in order for you to pay off the $6,500 with your minimum monthly payment, you're gonna end up paying over $25,000 over your credit card career, assuming you never rack up another dollar in credit card debt. But what are most people doing? While they're making the minimum monthly payments, they're also growing their balance. This is why it is so important for you to understand how the banking system works, not so you hate the banking system, but so you can understand how to win in the banking system. And the real way to win is to build your own financial education, to stop spending money you don't have, to control your money, to control your financial education and start using your money as a tool instead of as a fool, like what most people do, because if you can understand the system, then you can use it to your advantage. I have extra cash, and you can use the bank as a place to park your money. You can use your bank as a place to invest your money, not just with investing in the bank, but also earning some interest from the bank with a high interest savings account. It's a very different situation when you have $100,000 in the bank generating you 5%, which is $5,000 a year of cash flow, versus you owing the bank $100,000 at 7%, 10%, 15%, because then you're the person that's making everybody else rich who didn't use the bank the wrong way. That's what financial education is all about. Now, if you got some value out of this video, I have 3 small requests for you. Number 1 is hit that thumbs up button. Number 2 is to subscribe to this channel. And number 3 is share this video with a fellow investor. With my contractor, he's like, look, the property's in pretty good shape. All we gotta do is do some cosmetic work. You're gonna be good to go. He said, don't even worry about getting a city inspection yet. Get it when we're done and you'll be fine. So later I go to find out that the reason my contractor was really pushing me to get this deal is because he